Okay, guys, so welcome to our monthly webinar. We are going to be going over Mastering Multifamily, a case study transforming assets. I'm here, your host, Jefferson Ortiz, with my co-host,
John Ortiz.
And essentially what we do is we partner up with passive investors to acquire large apartment buildings, and we typically can get them double-digit returns. So yeah, let's get rocking and rolling here. So okay, so if you want to go over the table of contents.
Sure. So we're just going to go over the table of contents in this webinar today, which will include introduction, if you're new here, the type of assets, case study, which is our Lincoln project, how we found and the original versus the actual projections, the importance of a strong team when you're optimizing a building, and a large multifamily versus a smaller multifamily. And last but not least, we'll go over some myths and facts, and we'll leave it open for some Q&A towards the end.
So quick introduction on who exactly we are. So we are a team of real estate professionals who specialize in acquiring and managing multifamily properties in the USA and in Canada. We understand the challenges of investing in real estate, especially when you're short on time. That's why we offer passive investment opportunities that allows you to invest in a diversified portfolio of value-added multifamily properties without having to worry about the day-to-day management. Here on the right side, you see a little bit of our track record and our team. So, our team has a combined of over 50 years of collective real estate experience, and a track record of success across various industries, ranging from hospitality to technology, government, small businesses, and finance. Here, part of our team is John, the managing partner, myself, Jefferson Ortiz, managing partner, and then we got Prashant Kumar, who is a partner senior advisor. And our team's track record here is 19 plus deals completed to date, 5 plus cycle deals completed to date, over 2,400 units under management, over 120 million in assets under management. That probably has to get updated since the last deal we closed on. Over 250 million in total transactions, and assets are owned in North Carolina, South Carolina, New York, Florida, Texas, Georgia, Alabama, and we also own some assets in Canada.
So right here, we're going to be actually giving away a free real estate book, which includes 50 terms that you should know about apartments and real estate and investing, and in general, everything that gets tossed in the industry. So really important stuff to know. So again, free content here. If you want to get to know it, just fill the information and yeah, we'll go from there.
How do they get the book?
Just fill out the information.
Yeah. Just go to our website. If you go to our website and you scroll to the bottom on the first page, you will be able to claim your free book.
That is correct. It is also on the website, and we'll include the link somewhere on this webinar as well.
Okay. So do you want to take it away?
Sure. So the type of asset here, another critical indicator we consider is our exclusive focus on value-add multifamily residential. This means that the asset we target do not include any commercial components. Additionally, it's essentially to emphasize that our approach centers on value-added opportunities, signifying a distinct value enhancement aspect rather than a turnkey or new development project. Understanding your investment criteria is a paramount importance. So in other words, there's many different type of investments when it comes to apartment buildings, and the one that we like and focus on and we feel brings the most value for your investment is the value add, which essentially means that the building is under management, underperforming, and it may need a little mismanaged, and it may need a little bit of renovations, nothing too excessive. And another assets that they have is turnkey. So essentially you're just banking on appreciation, and those usually generate a little bit of lower cash flow.
Yeah, well, I mean, especially now in today's environment, right, where a lot of people thought they were going to be able to purchase all these new development, construction costs have gone through the roof. Interest rates are killing, developers and constructors. So, we like to buy existing assets rather than new development. And the other thing that I wanted to add to this is that, again, this is residential. I know there is some buildings that have a commercial component to it, but we specifically try to focus on residential only, no commercial, as we find that it's through times, hard times, and when the environment is not at the peak, their residential seems to perform a lot better.
Yeah, and we'll go over the exact project that we're going to be sampling today, the case study. You guys will be able to see this is a beautiful example of what a value add apartment building is.
Yeah, this is more to let folks know exactly that you must know what type of asset you're gonna go after, and you have to have an investment criteria before anything. Okay, so like John mentioned, we're gonna be going over the Lincoln project, and this is gonna be a case study. As you can see here on the screen, you'll see a picture of the asset. It was recently painted, so giving it a nice appearance look. So some features on Lincoln. So Lincoln is a purpose-built apartment building. 50% of the units are 2 bedrooms, 50% are 1 bedroom, and it was built in 1975. So that's typically, we like to have 1970s and newer product. And we picked this up right around $109,000 per unit. Now, one thing to point out is that not assets, but single family houses in this zip code, in this like literally within 2 minutes away, are trading at around $800 to $900,000 per property. And we're picking them up at $109,000. So I did want to point that out, because that is one of the advantages of multifamily, is that we can pick it up for much lower than what other people are paying for these properties, or for single family houses rather. Now it does have a pitch roof. It does have the outside is brick and cement, and cement is the exterior. It has over 12 plus parking spots. I think even more than that. Below market rent, so the rents are very much below market. And it's, like as I mentioned earlier, it's in a prime location. It's in the north side. It's in an A plus location near a brand new subdivision development, like I mentioned. And this deal was sourced off.
Before we go in and try to find deals and to be able to put on the table and work with, we want to study the essentials and indicators of that market. What is the job growth like? What is the population like? Is it worth going to this market and actually making on a full project, essentially? So one of our top priorities when it's assessing markets, it's the economy behind it and the environmental factors. Ensuring a growing population over time is a fundamental aspect, and we constantly monitor it. So if you live in that market, you should be familiar enough with what's going on around that area, or it's specifically in that area, because sometimes when you're focused on a specific area, the other sub-markets or other cities and towns surrounding it also bring strength to that market, right? So I just wanted to put that out there.
What are some of the things that you see?
So some of the stuff that we see in here, we've got Canadian Tire with 1,400 jobs. We've got Niagara College, which is one of the top colleges in that area. And again, we've got Plaza Corp, which is a 130 unit retirement home residency. We've got, what else do we got here? Rates.ca with over 300 jobs as a company exceeding in digital insurance. We've also got a 700 million private sector investment since 2017, which is
$1 billion.
which is again, this is what drives the economics in the city as far as jobs and other migrant foreigners moving into that city. We've got an 18.6 million own land of sales and a $10 million square feet new 1 million, my apologies, new industrial and commercial development. And it's a strong labor market. So some of the Welland's largest employment sectors include healthcare, retail, education services, accommodation, it's close to the US as well, manufacturing, construction, public administration. So strong numbers for this market. So these are some of the numbers, some of the things that we like to see whenever we're going to secure a project.
If you want to talk a little bit about who the major employers are.
Yeah, so some of the major employers, we've got, like we said, Canadian Tire, Niagara College, employing over 530 employees, 1,400 for Canadian Tire, Rexroth, which is a big company, which they do car manufacturing parts, Welland Tube with 250 employees. So again, lots of different diversity and the economics here for Welland.
Yeah, no. Something I just wanted to add is that obviously this is exactly what you look for in a market. We want to make sure that it has a diverse when it comes to the employment. We don't want to go into a one horse shoot on I think it was Michigan. Michigan, where they were so dependent on the industrial and car factory that as soon as that tanked, the whole market tanked. So this is exactly what you see with healthcare, you see education, you see a diverse of different employments and employers, which is ideally for when, the market doesn't perform as projected. So the question that I know a lot of people are going to have is like, okay, this is great. How did you find the deal, right? And we haven't talked about the deal yet, but how did you find the deal? So it was an off-market building. And through our various marketing strategies, we found that perseverance and consistency make all the marketing effective. When it came to this deal, we were cold calling property managers and real estate agents, and 90% of the calls resulted in rejection. People saying, no, not interested, give me $100 million and so on. Now, what we did is we persisted despite the frustration. A few months later, a seller reached out and we knew this was our chance. So we contacted them and visited the building. And we'll get into the story a little bit more, but I just wanted to kind of give you guys a breakdown of how we found it. And these are some of the benefits that we see when we're sourcing deals off market. And just to kind of backtrack even a little bit, off market or private deals just means that either they're not listed on the MLS, on the market, or so other is a broker that has a pocket listing or some sort of off market that they want to do without putting it on the market, or an exclusive listing, or it is when you go directly to the seller. So there is, again, no realtors involved in that case, which is how we found this deal. So there was no realtors involved. We just went directly to the seller. Now, here's some of the benefits, like I mentioned. There's more negotiation flexibility. Direct communication allows for more flexibility in negotiations, creating a benefit for both parties. What we found is that whenever there was a realtor involved, the negotiation seemed to go sideways because, they're trying to represent you, they're trying to represent the seller, it's just, there's a mix in there, right?
Correct. And just like that game, telephone communication, right? You're trying to communicate something, it can just get lost in translation between many different parties along the way.
Yes. Second point we have here is build better rapport. And this is really important when it comes to multifamily. Establishing a direct relationship can lead to a better rapport and trust between the buyer and the seller, potentially resulting in favorable terms. Now, why this is so important is that I think we've seen it even in the States when we've submitted LOIs, is that the deals don't always go to the highest bidder. It actually goes to the ones that have the most track record, they build the most rapport, they understand the seller situation the most, and can actually close and perform on deals. So building rapport with whether it's a realtor or whether it is the seller in this case, because we're going off market, is crucial. So off market allows you to build a rapport, get to know the seller, get to know his situation, what he's looking to do after he sells, and so on. And then the third point we have here is creative deal opportunities. Off-market deals often present the creative opportunities that may not be available in more traditional market settings, allowing for unique and mutually beneficial agreements. Now, this particular deal that we're going to be going over, we were able to also get, I forgot about that, we're also able to get $100,000 seller financing. It's called VTV, vendor take-back mortgage, or seller financing. So we were able to get $100,000 seller finance, whereas with most realtors, they're not even familiar with what seller financing is, or they don't want to deal with it because it's too complicated. So by going off market or going directly to the seller, we are able to get more creative with other terms. I know we also have seen people that do like a long closing and then they'll start working on the property before closes. So again, just so many different creative ways you can get here. And then the last but not least, and I think we've mentioned this like 2-3 times, but it's so important, clear communication. Direct contact reduces the risk of miscommunication when discussing and implementing changes or adjustments to the deal, streamlining the process. So I guess what I wanted to add to that is that when it comes to multifamily, it's not as simple as single family, where you just put the offer, you get financing, and you close. With multifamily, there's a lot of more due diligence that are done. There's phase one environmental. There's you got to check that all the rents match what the seller provided you. You got to go through all the units. You got to bring your contractor through. You got to sometimes the lenders will require an appraisal, right? So there's so many different factors, and sometimes you do have to retrade, which means you have to renegotiate the price. And by having clear communication with, like, direct communication with the seller, it just makes it a lot smoother, and it makes relaying that message so much smoother. When you have to make an adjustment, you have to extend the closing date, you have to change I don't know, the conditions, or you want to add a condition or so on. So it's really important. So these are just some of the benefits of sourcing deals off market. Anything you want to add?
No, I mean, again, off market is a different environment, and it works a lot better in your favor as far as negotiating throughout the process. And having direct communication with the seller is really important, building that relationship.
And I mean,
Especially if maybe they have, other apartment buildings that they might want to offload in the future. You can always secure your spot there and building communication. So I think that's really important. And there's also things that even some of the sellers that are mismanaging buildings or that just don't have enough time in their hands have no clue sometimes. As much as they think they know, throughout the process, they don't know what is really going on in the building, right? Maybe they missed a broken pipe, but it was never brought to their attention because, again, they had no idea, right? So we're going to talk about why we love this deal and why it was one of our favorites. So again, like any other project, one of the most important things is numbers, etc. So what made us really love this deal was because, again, the numbers, the average rent for this were approximately 700, primarily due to outdated rental rates, neglected maintenance, mismanagement, and lack of vision. Our approach to evaluating this value add in property wasn't solely reliant on its current income. Instead, we focus on the pro forma figures and envision our exit strategy, reverse engineered our offer based on this analysis. So that's another, when we say value add in apartment buildings and apartment syndications, is value add in many different ways. We're talking about value add on appreciation, making the property look better, bringing it back alive, making it more efficient with any HVAC work, electrical, etc. But also value add on the NOI, which means, again, it's underperforming and optimizing on that opportunity.
Yeah, I mean, I don't think there's much to add. I know it depends on the asset class. I know in the States when we're looking at assets, we need to be cash flowing from day one. Whereas in Canada, I guess in Ontario, you're looking at what the pro forma is and you're reverse engineering and seeing how much it's gonna cost you to renovate, how much you're gonna be able to achieve in rent. So it is a different underwriting, I guess, when it comes out. But again, this one, we've seen the layout, we've seen the bedroom, like as you've seen, half of the units are 2 bedrooms. So we kind of ran our analysis based on what we can project for the rent. So, that was something really good. And the main thing about this one, I think there was no major capital expenditures, like just minor cosmetic work on the interior and exterior.
And adding an additional unit, which
which we'll go over that. Go over that. Okay. Second thing, like I think I just mentioned it, is unit mix. Something that was very appealing from this deal was the unit mix. And the significance of unit mix in the multifamily sector cannot be overstated. Like I mentioned, with having over 50 to 60% of the units as 2 or 3 bedrooms, as opposed to an exclusive concentration on bachelor or 1-bedroom units, which can lead to significant shift in potential rental income and not even include turnover. With the 1-bedroom and bachelors, they have the most turnover out of any other multifamily. Typically, when it's a 2-bedroom or 3-bedroom, typically it's a family, a couple, so they're more stable. They're not going to be bouncing around places as much. So, for instance, if the potential rent for a 1-bedroom unit is $1,200, and the potential rent for a 2-bedroom is $1,600, the difference amounts is to $400 is the difference. While this may not seem like substantial, like much at first, in multifamily context, this translates to a yearly increase of $4,800 per unit. So that means that we're getting an additional $4,800 per unit in income. Breaking it down a little bit even further, with an average, which I mean, I think is more average in most markets here, it's a 5% cap rate. This would result in an additional value of $96,000 per unit. And this is why we love this business. I mean, so an additional $400 of income. So between a 1-bedroom and a 2-bedroom is an additional $96,000.
So comparable rents. One of the biggest factors in multifamily revolves around comparable rents. The reason behind it, its paramount importance lies in the necessity to ensure that when implementing your business plan, there is a robust demand to occupy the new units and the updated market rental rates. In our case, we already had existing assets in this market, which made it straightforward process of just rinse and repeat. And again, this goes back to the economics of the market and understanding as soon as you're done turning over a unit, it should be no problem putting it back on the market.
Yeah, and I guess something I wanted to add is this is so important, especially even in the States, it's the same thing. You want to know exactly what your competitors are charging for rent. You want to know exactly how much you can charge for rent because it depends from place to place, from city to city, from area to area. So, this was another thing that really stood out to us. We already had properties in this market, so we understood exactly how much we could get for rent. And this is something really important. I know a lot of people will talk about in the single family space, they'll talk about single family comparables, but in the multifamily space, the comparable rents are even more important than the single family comps, because this is how much you can charge for rent. This is how much competition you have in your market. You know exactly what your competitors are changing in terms of amenities, in terms of
I think we're probably want to be top in that area after.
Yeah.
I mean, we painted the exterior of the building and, it comes alive and people are viewing places to rent. It really stands out. And
Yeah. Well, not only that, but this is 2 minutes away from a brand new subdivision that includes an apartment building. So that's going to mean that everybody who wants a brand new apartment is going to go there. They're going to charge, I don't know, $2,500 or whatever it is. And then when they see whether they're fully occupied or whether they want something cheaper, we're literally down the street. If they're charging 2,000, we're charging 1,700, 1,600. I mean,
and we're still overperforming on
and it's still similar. It's very much similar amenities. Like it's going to be brand new. So, anyways, so yeah, if you want, I'll take this one. So essentially, we just wanted to show what our original projections, and we were just talking about rent, so this actually falls perfectly. Our original projections versus what our actual projections are. So for this particular deal, our potential rents that we were budgeting for, and we love being conservative for this particular reason. We were budgeting that 1 bedrooms, we were going to get $1,300. In 2 bedrooms, we were going to get $1,500. Well, the truth was that we're actually getting $1,500 for the 1 bedrooms. In 2 bedrooms, we're getting right around $1,700. So that is an additional $200 above our pro forma number, which means a lot, as I showed you earlier, what $400 does. So this is phenomenal. This is great news for us and our partners. And then last but not least, we have a third point there is we are legalizing one of the units. So there's one unit that is not legal. So we're legalizing that. And we're also adding another unit, like John mentioned, in the laundry. Now, this will result in an additional $1,500 for the one unit that is legal, and then $1,500 for the one that we're going to be building. So this is an additional $3,000 monthly, $36,000 annually. And then again, when we take that amount and we divide it by 5, which is an average cap rate, this works out to be an additional $720,000.
Which is amazing, and it's a no-brainer.
Like this
and
is why we love this business.
It's really important for the lender to have legal units to be able to
Yeah, they're not legal.
if they're not legal, they're not counting that income, as we know. So it's important that we legalize the units. And when we're doing our refinance or selling the building, it comes in handy, and it drives a huge immense of value towards the building.
I mean, this is crazy. Like, I don't know any other business or asset class where you can literally add 2 units and potentially increase the value of the building by $720,000. Try doing that with your single family.
Right.
Okay. So here's just some pictures, some before and afters. Really nice. We're really happy with how it turned out. So this is a before and after. As you can see, white, dirty. Now you got a nice gray, very modern looking.
Yeah, and we're just gonna talk about some of the before and now pictures of some of the unit turnovers that we've done. As you can see here on the left, just very, very scrappy, just dirty, not very appealing. So
only if you could smell what it smells like.
Oh, for sure. And so now you got here to the right, brand new appliances, brand new flooring, fixtures, cabinets. It's a whole turnout. So this is just a perfect example.
Yeah, because I guess we want and we wanted to point out that we don't just increase the rents. I know there's some states, like in the States, I know some places you can just go and increase the rents. We're really adding value to these units. I mean, we're giving people brand new units at affordable prices. With all the bells and whistles that you need. You got your steel appliances. You got a dishwasher, which was not there originally. So we're literally providing shelter and providing clean, good property units for our tenants. And, that's why we're so passionate about this business, is that we're providing shelter for people. Like just kind of backtrack a little bit, tell a story. We're from Colombia. So, the fact that we're here and that we're blessed to be here and that we're blessed to give shelter to people. I mean, this is just it's phenomenal. So we're very grateful.
Yeah, here's another before and
This is
after in one of the bathrooms. Very rundown tenants and units, just not very upkeeping. As you can see here on the right, more clean, more appealing. The way that brand new, and so we're promoting that healthy living clean style for tenants, which is really important,
Yeah.
and just providing better housing in general.
Yeah, I mean, some of these properties, these units come with tenants, and when we go into some of these units and they're just a mess.
Correct.
smells
And you also got to
horrible.
take in the factor that it is not their unit, right? Even if they're living
For a
there a
couple
couple of years, it is still your responsibility to keep it clean, to not break anything, and give it back and treat it like how
Yeah, no, but I guess what I wanted to add is that whenever, I'm a father myself, so when I see properties like this or, they're, very bad to live in, and we see kids in there, really, we get a feel for it because, we're able to provide a clean, nice, safe environment for these new generation to grow up. So very beautiful. So I know this is a common question that we get, and I know some common question that investors may get is, how do you know how much to rent versus how much the rent is going to be? So we wanted to provide some value here to the folks listening to this or listening to the recording. So when it comes to setting your renovation or due diligence budget, including in some cases cash for keys or extra buffer for the renovations, a simple yet effective way to approach it, and this was actually taught by one of our. If you're investing $70,000 per unit for renovations, but you can increase the rental income by $1,000, we take that $1,000, we times it by 12, which is a year, and we get $12,000. Again, we take the $12,000, we divide it by an average 5% cap rate, we get $240,000 of additional value to this asset. Now, after you deduct your original $70,000 investment, you're left with 170,000 and more. Again, this is why we love this business, right? Now you times that by however many units you have, voila. Anything you want to add?
No, that's absolutely correct. And again, it's the value that you're drawing and the future that you're getting for turning over this project essentially.
Yeah, because I know, especially in Ontario, and I know a lot of people could relate to this that are in Ontario, is that when we have to give cash for keys to tenants, and you got to pay them, let's just say 20, 30, even 40,000. I mean, we haven't paid that much, but let's just say you pay them $40,000. But let's say in a place like Toronto, a place like Hamilton, you can increase the value by $500,000. Do you really care to spend $30,000 if you can push the value per unit by 500? So that's a good way to look at it. And I think that's how most, savvy investors look at it.
So the importance of a strong team when you're going into this project is extremely important. And this is why we partner up with passive investors that don't have the time to do the everyday operations, because there's a lot of moving pieces throughout the whole transaction, throughout the whole optimization process, and it can get overwhelming. So make sure that you do your due diligence on your partners or on your projects that you're working on. So similar to legendary figures like Michael Jordan, Tom Brady, Grant Cardone, the importance of a strong team cannot be underestimated in the multifamily investment. Your team has the power of either propel you to success or hinder your progress. So we firmly believe that our team is a driving force behind our achievements. And here are some of the key members of our team who played a pivotal role in the success of this project. And again, these are all these are all extremely important. So the in-house property management, the asset management, and the project manager, the leasing department, extremely important. In-house construction team, another key factor. Mortgage broker, inspector, engineer, architects, investors, paralegals, and lawyers. Accountants. Each member of this dynamic team contributes their expertise and skills to ensure that the success and growth of the multifamily investors, is, and again, we're doing this day in and day out. So we're turning this project over. We're going in, we're making improvements and progress every single day, and I think that's what counts. Yeah, so I guess like I mentioned, just like Michael Jordan, Tom Brady, all these great, amazing people had a great team, had coaches, had mentors, had the staffing, Tim Grover, like I've been telling you, he's the reason why Michael Jordan became who he was. So
I feel like I said, having a strong team and many times a lot of people want to get into multifamily and they want to get into apartment buildings and they don't realize what really goes on in the back. They don't really see how many people are in the trenches helping us out. So that's kind of why we want to create this, is to show people that it's not just buy an asset and, you know, get tenants out. There's a lot more moving pieces. You need to have a strong team, and we believe that we do have a really good team both in Canada and the US. So that gives us all the confidence in the world when it comes to acquiring these assets. And again, these are some of the people that you could have on your team. But I think one of the things that the last thing I wanted to mention is that with multifamily, the reason why we love it so much because it's a team sport. This is just part of the folks that are involved in the day-to-day, but we're not including, you know, like asset management. Oh, we do have asset management, but asset management himself could be 5, 6, 7 people. Project manager could be 2, 3. Like, so all these have multiple people in each category. So I just wanted to point that out. And yeah, I guess we're gonna be the next MJ of multifamily.
And larger versus multifamily here, we wanted to share some stories of smaller multifamily properties that we have and we've owned as well, of course, pros and cons, and the reason why we have moved away from the smaller multifamily to focus on larger buildings. So we'll start over on the red side, which is the cons, the negative.
Start on the right, start with the positive.
No, let's start with the negative, I say, and you know, finish it with the positive.
Okay.
We'll see some of the negative things here. 2 units. Again, if one tenant leaves, you're 50% vacant. God forbid they both leave, you're 100% vacant. We've had that for sure. Not using property management because it's not large enough. So your time and your effort has to be spent on some of the problems or hurdles that come up.
There's not enough income, and even single family houses, like this has at least 2 units. Single family houses, they have one income
that is
coming
correct.
in.
So it's just not enough income. So you got a budget for contingency, and it just draws a lot more time out of your hands, especially if you're a busy professional on your day-to-day basis.
And then you try to avoid those kind of expenses, right? You try to manage it yourself, then it becomes a full-time job, and then you get a bad tenant in there.
You want to expand on buying a unit that had no stove?
Sure. So when we bought this asset or this property, when we originally did the walkthrough, we did not notice that one of the units did not have a stove. And so we move all our stuff, we buy the property, we move our stuff. I moved into one of the units, and when we get there, John looks at me and he says, "There's no stove." And I'm looking around the unit. There's literally no stove. I've never seen that in my life. Apparently, the old tenant that used to live there, he used to go outside and cook in a little, what do you call it, like a grill, like a grill. And so we had to get a brand new, you know, plug in for the stove. We had to get, you know, the fan and all that other stuff. But you know, that's something I guess to look out for if you're buying a propery.
Absolutely. So that's we'll move on to the positives.
No,
I mentioned that.
You said?
Yeah. Full BRRRR. If you don't know what a BRRRR is, pretty popular in the investment industry. Which means buying, renovating, refinancing, and repeating. And rent. Right time to buy. But in a good market, which again, these are rare, especially considering today's factors in the economic today with high interest rates. Locked in a fixed rate, which is a plus.
2% interest.
1 vacant unit, and we had an amazing good contractor and no major capex. It was a bit of a capex.
No, but not like roof, window.
No, that is true.
That's what I mean by major. I mean, I know we had to change the HVAC. So these are some of the benefits. Like again, good market, right time to buy. We bought it right when the market was kind of slowly going up, and we were able to refinance right when the market was at its peak. And right after we refinanced, the market tanked. So the timing couldn't have been any. Now it does produce us some cash flow. However, keep in mind we still have this property. And we just had, I don't think I told you, but we had our property manager call us and told us that a tree had to be removed from the back as per the city. There's a city bylaw that came by, or somebody told the city there was a tree that had to remove. That is going to cost $800. So if there was $1,000 of monthly cash flow, it's gone now. So again, that's why we're moving away from the smaller multifamily. It's just one major thing, one little thing, and your cash flow is gone, right? One roof goes, one window goes, your cash flow is gone for years. So, and then the last thing I wanted to expand on is the units, the one tenant that leaves. So with this particular deal, it was one of our first properties. And when we bought it, we wanted to manage it ourselves because we've said, property manager, we can do it. We rented one of the units, no problem, good tenant. Second tenant, it took us a little bit of time to rent it out. So we ended up just kind of the first person that came, and we didn't do the proper due diligence when it comes to tenants. And so she ended up staying there. She's right after the first month, she stopped paying rent, and she was in there for close to about a year before we could get her out. She cost over $20,000 in damages, and she owned over $15,000 of rent. And so that's why we said we're never going to buy a duplex until we bought this one.
Yeah, that is good. We got another
So yeah,
larger.
I'll talk a little bit about this one. So this is a duplex, another duplex. Now I'll talk about some of the benefits, and I'll go into the bad. I'll do the opposite of what John did. So the benefit is that we bought it at a steep discount. We bought it for $325,000. It was vacant upon closing. Only light capex needed. So again, similar to the other one, really good size units. They were like two bedroom, but they were really good size units. Upstairs, it took us 2-3 months to renovate, maybe one unit and renovate the other unit, which is great. Existing asset, so we had an existing asset in the market. So it was a rinse and repeat when it came to the rent. We bought it with separate entry to the basement, and I guess I forgot to add in there, it did have separate hydrometers, which was a plus. Now, so that was great. This is when the market was still at its peak that we bought it. Yeah, it's still at its peak. It was 20. Yeah, we bought it for 325. So real tremendous deal. It was listed for 370, I think. So we got a good deal. 330. We bought it for 330. Now, the negative timeline. We expected this project to take no more than 3 months. It took over a year. And the main reason for this, and I think it might be in there. Yeah. So instead of 3 months, it took a year. And this can happen to anybody at any point. Second negative to it is, or second downside of it, is that we ended up adding an additional unit to the basement, which is what caused the delay. The upstairs units, we finished it in 2-3 months. The basement took a lot more money. We had a really bad contractor that we had a bad experience with. Definitely never use them again. And it took over a year, and there was still a lot of things that we had to get another contractor to come and fix. So safe to say, we will never, ever add an additional unit to a building like a duplex. Well, we'll never buy a duplex anyways, but we will never buy an additional add an additional unit to the basement or not have the right team. So again, we hired the wrong contractors for the basement job. They took long, they ripped us up, and they left, essentially is what happened. The property had no parking. So when it came to renting it out, that was something that we struggled. When it came to renting it out, we struggled finding a tenant for a little bit because we had no parking. It had no laundry because we converted the basement to a unit. So now there was no laundry. And then the worst part of it all is that we were not able to refinance all of our capital. Even though we bought it for 325, it appraised for 675. And some of the reasons, I guess, why we couldn't refinance is with multifamily, single family, they're still looking at you as the borrower as opposed to the asset itself. Even though our appraisal was showing 625, ourselves and our
need that income to debt ratio on that refinance, you're not going to be able to. Yeah, so either ourselves, because at that time we were self-employed, either ourselves or a partner, we couldn't refinance with like a regular loan or a regular lender. So we had to go with a private. And the private did not give us a good LTV or favorable terms. So we ended up selling this asset. But just to kind of give you guys an idea why, again, we're not investing into small multifamily, is that we actually ended up making close to nothing on this. Like we hold it for like, no, we didn't. We lost time, energy, but we didn't lose money, but we didn't make any money, even though our plan was originally to refinance in 3 months, which we could have done if we did a proper due diligence, even with our partner, that, if we would have qualified but anyways, wanted to share these stories. We want to be transparent as to why we have, shifted to multifamily. I know there's a lot of people stuck in the duplex, the triplex, the single family, even up to the fourplex. But, these are just some of the benefits and some of the pros and cons that we found. Now, what we're going to be going over, and I'll go over maybe the bad part of it or the benefit. You can talk about the vanilla, but I'll talk about the cons. I'll talk about the cons first of single family or duplex over larger multifamily.
And when we talk about larger multifamily, we're talking 8+ units, 100 units. I mean, essentially what we're talking about. So the downside of single family or duplexes or smaller multifamily, again, is one vacancy can cause you to be 50 to 100% vacant. Harder to get financing because they're looking at you as the borrower as opposed to the asset. Harder to manage because you don't have an in-house property management, or if you don't have a leasing department, the property manager is not really going to care as much because they're not getting as much income. It's value based on market income. So right now the market is hard. Some people that were planning to refinance, they're screwed, right? Whereas with the multifamily, is all based on net operating income, expenses, income. So it's a lot easier to control. So harder to scale. It's harder to scale 100 single family houses as opposed to 100 units. We've literally bought 100 units in one shot instead of buying a whole bunch of single family houses. Minimum to no cash flow. In today's environment, duplexes, zero cash flow. And like if you have a variable rate, or if you're buying a brand new duplex, you're not going to cash flow. Simple as that. Can't help investors that only have 100,000. And I'll expand on this a little bit. If you have $100,000 and you wanted to invest and get a return with a larger multifamily, that will get you into a multifamily. You'll get a return. You'll typically 2x your money. With 100,000, it's simply just not enough. Even if you were to do a JV partner, it's just not enough to buy the property and to renovate the property and hold the property, and you got to qualify for the property. So it really limits the amount of partners that you can bring or who you can bring, as opposed to the multifamily, larger multifamily. You can bring in 100 people at 100,000 each. You know what I mean? So it gives you that opportunity to offer this to friends, family, and so on. And then, multiple capex per property. If you have a single family or if you have a duplex and you have a bunch of them, one roof goes out, one windows goes on, one HVAC goes out. And so you have all these, capital expenditures. One of our mentors has mentioned this and gone over this a lot. He owned over 50 million, over 5,000 single family houses, or 500. Was it 500? Yeah. 5,000? Was it? It was a lot. He owned a lot of single family houses and he'll never buy one. And he's very keen on multifamily for the reason that we mentioned. So that was the bad. And I'll let John take over the benefits of multifamily.
Yes, some of the positives here is again, easier to finance as it's based on the evaluation of the building and not necessarily your own personal net worth. Easier to manage, again, with a bigger in-house leasing property management team in hand. They're taking care of that project, and it's just a lot better. There's a lot of bigger impact as far as all the economics and factors of the building. The value is determined based on the net operating income, which again, you can play with, you control, you manage. On a single family asset is just hard to do so. And it's again, it's based on comparables and sales. And again, it's not easy to scale. It's easier to scale in multifamily sector, easier to influence its value, control and manage it. And it's easier to create cash flow. Some of these buildings are cash flowing from day one. Once you optimize them, you're able to really capitalize on that wealth. True legacy assets. It's one of the best assets out in the market compared to the stock market, bonds, crypto, etc. One or minimum roofs, minimum windows, and better amenities. So some of these buildings come with pool, gym, membership club, dog park, and it's just a lot. Kids park is just a lot better. A lot of people.
Single family has no amenities in duplex.
That is correct. That's correct.
So, and the last thing I think I didn't add this here, but one thing I wanted to add is that you actually are able to attract a better tenant on a larger building than you are on a smaller duplex or single family houses, because again, the amenities. And so you're able to actually attract a better tenant. Maybe if a tenant wants to have a gym in his building, or if they want to have a dog park, all these other things, right? So we're actually able to attract a much better tenant than we would have if we were buying a duplex or a triplex or a fourplex. So wanted to share this so folks can see the difference in why we specialize in the larger multifamily rather than the smaller multifamily or single family. And I put them in a category because I think they're like the same pretty much. Okay, so we're going to be going over the top 5 myths about larger versus smaller multifamily / single family house. So I'll take the first one and John can take the second one. The myth number 1, smaller multifamily is easier for passive or active investors. The truth is, larger multifamily offers property management. Smaller properties can require more hands-on involvement, whereas larger multifamily properties often have professional on-site management, making them attractive for passive investors seeking a more hands-off approach. And I just wanted to ask John here, how much do you remember us picking up all the materials from Lowe's and everything and dropping it off at the duplex? How much? I guess how much involvement, how much hands-on involvement?
It's a lot of involvement, guys, especially if you're starting out and you don't understand what truly goes into it. And
How much time?
you're trying to budget every penny because you're starting to see that it might not work out as you expected it. So it's a lot. I mean, we carried close to 50 boxes of shingles and material in the middle of the night just to get things going, to have a better price with the contractor. And is it really worth it at the end? That's part of the process. But again, you got to take a look at your time versus your effort and what you're doing with it if you want to scale your business. The next one is going to be smaller multifamily is more accessible. Truth is, larger multifamily provides economies of scale, which is extremely important. While smaller properties may seem more accessible, larger multifamily properties benefit from economies of scale, which can lead to reduced cost per unit and a higher overall return.
Yeah, I mean, and just to kind of touch on this a little bit, right? We all, a lot of folks want to start with a single, they want to start with the duplex, right? But there's actually a much, I guess it depends on the person, right? But I guess we ourselves are given access to Canadians to invest in Canadian or American projects. So we are given access to those deals. Now, I would say that the US has a lot more access to 100 plus units as opposed to Canada. But yeah, again, it's just, I mean, if I could go back, I'd go bigger, faster, sooner.
Absolutely. Number 3, it is smaller multifamily is less risky. Again, the truth is large multifamily offers diversification, and large multifamily properties spread risk across multiple units and tenants, reducing vulnerability to the vacancy of a single unit, providing greater risk for mitigation. I mean, multifamily destroys single family any day of the week. It blows it out of the water.
When the market goes down, like the way it is right now.
Correct. And I think we did another webinar on some of the economics of the market right now and how we're handling multifamily and the high interest rates that we're in right now. And tracking back to 2008, multifamily was sustainable and peaking during the downtimes of the recession in 2008. Because again, economies of scale and the single family got crushed.
Yeah, I mean, or even if we think about it, if we go back to when we're underwriting deals, on a larger multifamily, we are budgeting aside for vacancy. We are budgeting. We can't budget because we have so many tenants. We have so much income coming in that we can't budget. However, when you have a duplex or a single family or a triplex, I guess is a little different, but even a smaller multifamily, you can't really budget for that. You can't budget for vacancy because there's just not enough income, right? What if you get a window or something that has to be replaced? So there actually is a lot more risk on the smaller multifamily, I would say, as well as, like, I think we just said it, vacancy, right? It's huge. If you don't have a tenant that's paying you, you're paying, right? Myth number 4, smaller multifamily yields higher cash flow. The truth is, larger multifamily offers greater cash flow potential. Larger multifamily properties with the numbers rental units, they have the potential to generate substantial and consistent cash flow, providing investors with reliable income streams. And again, I can honestly speak from our experience. We had bought a duplex, again, in Ontario, up north, and, we thought it was a great deal. We picked it up, $190,000 duplex. We thought it was, we thought we were the smartest people in the world. Come to find out, we made almost 0% cash flow because it was so far, not the right property management, not the right tenants. There was no tenants that wanted to rent their units. And so we really did learn the hard way that there is no cash, there's minimum to no cash flow. And that was on a variable. And we ended up selling that property. Can you imagine if we've had it right now? It would have been negative, super negative cash flow. So again, that just goes to show you that now on the larger multifamilies, the one that we just closed on, it cash flows from day one. I think that's such a rare thing to hear in Ontario or Canada. Like, it cash flows from day one. But still has potential to increase the cash flow over a life of the period. So it's just like, I mean, when it comes to making sense,
No.
and it depends on the business plan, of course, right? Like,
Here we're going to be talking about myth number 5, which is small multifamily is simpler to finance, which it's not true at all. It's extremely false, actually. Larger multifamily qualifies for commercial financing. Smaller properties might seem easier to finance, but larger multifamily properties often qualify for commercial financing, offering favorable terms, leverage, and stability with less personal capital required. Let's remember, duplex single family homes require your net worth and your income in order to purchase that property, where commercial properties is based on the NOI of the building.
well, I guess I didn't think about this, but now I'm thinking about it as you're saying that, is that some people that were projecting to refinance their property, those numbers are not working at all with the new interest rate. So that doesn't make sense. So
There's a lot of
now,
people that are losing cash flow right
wow,
now.
I didn't think about that, but now I'm
Because
thinking about
even
it.
if they were cash flowing $200-$300, $500, and they're happy every month, when the interest rate renewed and now it hits their mortgage, you got to think about if they go
Or people that
from
want to
2%.
bear it. No, well, I'm thinking about
From 2% to 7%.
Yeah.
They're paying an extra $1,600.
Yeah, well, I'm thinking about just a regular person that was like, I'm gonna buy this property, I'm gonna keep it on a variable so I can refinance it. Let's say they went through the process, they finished the project, now they're gonna refinance. The bank's looking at that asset and they're looking at them more than anything. It's not even an asset. And they're saying, you don't qualify for this anymore because of the interest rates. So now instead of getting 70, 80% LTV, they may be getting 40 or 50% LTV, which is crazy. Oh, wow, I didn't even think about that. Yeah, that's tough. I think the timing order for us couldn't have been better. So that is pretty much all we have here. So we will take some questions. I know we had some questions online, so let me go to those as well. So some of the questions that we had is, are you buying in Canada and not in the US? So these are some questions that came in earlier. So we're very active in the US when it comes to 100+ units. We have, like I mentioned, built a really good team in Ontario, in Hamilton specifically. Like that's kind of where our bread and butter is. We're based out of Hamilton. But our long-term play, I'd say even within a year, is to be full-time, full force in the US. So while we're here, we're acquiring as much properties that make sense and as much properties that we can make the numbers make sense and buy it, I guess, essentially. So we're active in both, but more active in the US, I would say. Some of these deals that we have here, we are open to assigning it. So that is something that we are open to because, again, our focus remains in the States when it comes to long-term. Anything you want to add to it?
One of the most important things is we are focused extremely in the US. That's where our biggest, latest, most favorable and higher return projects are. Again, we're based out of Canada, but we have opportunities in the US to help Canadians breach that gap. Essentially, we are a vehicle for Canadians to invest in the US. And as we all know, Canadians are very conservative. And, for those Canadian investors that are too afraid to take a leap and want to stay in Canada, we have some opportunities in Canada as well. But as we continue to educate Canadians on why we love investing in the US, we have great investors that have invested with us in the US. They're extremely happy with the returns. We're happy with the projects. Again, our company is investor driven. So we're investors. We're putting our investment on the line. And, with these projects in the US, when they're more favorable and you're talking about assumable loans that we're taking over and we haven't seen those rates since 2018 and we're able to cash flow from day one. It just makes a lot more sense. So,
okay. Thanks for that, John. So we have another question here, which is, how are we still buying assets in 2023 with the interest rates? And I think we did a webinar on this, so you guys can definitely check out our most recent webinar. Was it a webinar or podcast? It was a webinar. Okay. Our most recent webinar that we did a couple of weeks ago. And essentially just to kind of high level stuff. Essentially we're doing a lot of assumable loans. So we're assuming existing loans that are fixed at like 4.5, 3.5 interest rate for the next 5 to 10 years. And that's how we're mitigating that risk. We're also, whenever we're underwriting deals at extremely high. Like we're budgeting like 7.5 to 8%, like on the South Carolina deal that we just submitted LOI. So that's how we're That's how we are mitigating the risk, as well as we're also putting, usually we put 6 months of reserves. We're putting, close to 7 months of reserves just to be able to waive, weather any storm that comes our way. And the last but not least, we are buying assets that don't need huge capital expenditures, or it's not cash flowing from day one. If it's not cash flowing from day one, like when it comes to the States, I guess I'm talking in regards, we're not buying it. If we are banking that we're going to be able to turn over, the other thing that we're doing is we're not projecting any rental growth for the next 3 years. So we'll buy it, we'll get it up to market rents, but we're not budgeting that the rental market is going to go up over the next 3 years. So that helps us, so that if it doesn't, in fact, grow, we're going to be fine because we already budget for that. But if it grows, if, we're able to implement those in rent increases, well, then it's just extra
Icing on the cake.
extra icing on the cake. Anything you want to add to that?
No, I mean, again, we're helping Canadians invest passively in the US with greater returns. If you're interested in partnering up, please schedule a call on our website, or we'll leave the link below.
Yeah.
If you want access to the 50 terms of real estate and investing, please sign up for the ebook. It's a great value, great content on there. And we'll hope to see you on the next webinar. Our next meetup will be sometime the end of November, which will be held we'll throw some details in the next couple of days or weeks.
Yeah, that's pretty much all the questions that we had online. I'm just checking Zoom here. I see Jenny's on the call. Hi, Jenny. How are you?
I'm good. How are you, Jeff and
Doing
Sean?
good. We're happy that you were able to join us. And what did you think about the webinar?
It's great. Yeah. And
Awesome.
it's very informative and you explain it very well. I love your presentation. It's nicely done, very professional.
Thank you, Jenny. It means the world coming from you. So thank you so much. And again, thank you for joining us. We appreciate it. I know it's
you do.
what is it, a Thursday evening? What is today? Thursday? For what? Today, like what is it? Yeah, it's a Thursday evening. So we appreciate you taking the time to visit us. We're just putting here this is just our website. If you guys want to visit us, schedule a call. You guys can visit that. And then last but not least, just wanted to leave everybody with this last quote of the day. So opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Did I say the word? Thimble? Yeah, thimble. Warren Buffett. So we are on expansion mode. We are buying. We are active. We are not we're not sitting on the sidelines. We're gonna take advantage of this opportunity. So yeah, we're very happy. And I see Martin, he commented Thursday it is. Cheers. Guess I may just missed a little. No worries, Khalib. If you missed it, the recording will be sent out to anybody who registered for the call. So you will get that probably tomorrow. And anybody else who missed it, they can go back to it. It'll also be on our YouTube page, which you can search Ortiz Equity Group. We have all the webinars are there, and the podcasts, they're all there. Yeah. So awesome. Well, thank you guys for joining us. I appreciate it, and have a good rest of your day.
You too. Take care, guys. Bye-bye.
Cheers.